Let us start the question of policy, monetary policy.
Yeah.
In hindsight, was the hike in December a mistake?
Well, Richard, I don't think so. 2018, the economy grew around 3%, unemployment rate near a 50-year low, inflation very close to our objective of 2%. So it made sense to normalize policy in 2018, and I have absolutely no thoughts that otherwise right now.
Right, except the sharp U-turn, the handbrake turn in policy statements from December through to January was pretty exceptional.
Well, I really don't think so. If you actually go, as I'm sure you have, go back and look at the transcript of that press conference and what we've said, I really don't think it's a U-turn. What we said going into 2019 is that we were looking at global developments. We were looking at adjustments in financial markets, and that was also something we emphasized at our January meeting. I think policy right now is in a good place, and we've emphasized that.
Where is policy? Is it wait and see? I will save you the breath of data dependent.
Okay.
I realize everything is data dependent, but where is policy now?
Well, right, Richard, we think policy right now is in a very good place, and that's appropriate because the U.S. economy is in a very good place. We can afford to be patient, and we can afford to let the data come in and tell us a little bit about where the global economy is going, but we think policy is in a good place right now.
By patient,
right.
I'm trying not to parse words, but what do you mean by that?
What I mean by patient is that we have done a lot of normalization in policy over the past 3 years. We're very close to our mandate objectives of full employment and price stability. And with that set of initial conditions, we can afford, without any presumption about timing, to look at the data come in and tell us what the next adjustment in policy might be.
So when the market looks and the dot plot suggests everybody thinks one more move this year, does that seem reasonable?
Well, there are certainly scenarios where that would be appropriate. There are other scenarios where we might not hike at all. It really is going to depend on how the data comes in. Let me talk a little bit about the dots. The dots give information about how individual participants, all 17, individually look at different scenarios for the outlook. But we don't vote on the dots. The dots are not a policy decision. They're one input into a process. So I wouldn't read too much into those dots right now.
What about then on the slowdown that is happening?
Yeah.
Of all the factors pushing this slowdown, which are you most concerned about?
Well, so far we have to admit, Richard, that we don't have all the data we usually do right now. So it's not even clear how much of a slowdown, if any, that we're seeing in the economy. The data, of course, was delayed by the government shutdown. Obviously there's a range of indicators that we look at. The labor market data is still strong. We've had some softer retail numbers. So we're just putting that together right now.
You've got China's slowdown.
Yeah.
You've got Brexit.
Yes.
You've got the trade war. Which of those three concerns you the most?
I think broadly, because China is such a big part of the global economy, obviously, a sharp slowdown in China, which we don't foresee, but if it were to happen, that would have consequences for all the economies in the world, including the U.S. Brexit, with all due respect, is primarily a big impact on the UK economy, a huge impact of the UK economy. We're very attentive to making sure that were a hard Brexit to happen, that the global financial system and the plumbing would continue to function, and we're confident of that. But we don't see Brexit as being a big systemic risk for the U.S.
And China and the trade talks, the trade war.
It's not yet a trade war.
We can discuss.
No. Oh, yes, of course. No, there are obviously very important ongoing discussions between the U.S. and China on trade. That is the most important trading relationship in the world. Obviously there are different scenarios for that. So far, that's not had a big impact on the economy.
The Fed's balance sheet.
Yes, sir.
It is esoteric into the realms of economic books, but now it's in the news.
It is.
The idea that you may stop running down the balance sheet because of the higher levels of reserves. Are you going to?
Well, what we announced at our January meeting, Richard, is that we've made an important decision at that meeting, which is we're going to formally adopt and embrace the operating framework we have which requires that we have ample reserves in the banking system. Now that we've made that decision, in coming meetings we can make important other decisions, such as when to bring the process of shrinking the balance sheet to the end and the pace at which to do that. We've not yet made that decision, but we will be discussing that in future meetings.
Are you close, do you think, in your view, not in the committee's view, in your view, are you close to the point where if you're going for abundant reserves policy, it's best to let it now settle?
Well, let me put it this way. There are a number of estimates by outside observers that to run an ample reserve system will require reserves somewhere in the neighborhood of $1 trillion to $1.2 trillion with a buffer. And under the current pace of normalization, we would get to that level sometime later this year, early next year. So I'll just leave it at that.